Everywhere you look, people are asking the same question. Is AI the biggest revolution of our time, or the biggest bubble we've ever seen? So, which one is it? To answer that, I want to step back from the noise and look at this question through the lens of one of the most thoughtful investors alive, Howard Marks. In his latest memo with a very simple title, Is It a Bubble? Instead of just shouting yes or no, he does something much more interesting. He asks why bubbles happen in the first place. Let's break it down. No jargon, no spreadsheets, just ideas, stories, and history. So here's the game plan. First, we're going to perform a little autopsy on the anatomy of a financial bubble. Then we'll check out the warning lights currently blinking red in the AI world. But wait, we're also going to play devil's advocate. We'll explore the very powerful argument for why this time, just maybe, might actually be different. And finally, we'll get down to the brass tacks, the investor's bottom line. When people argue about bubbles, they usually argue about the technology. This technology is revolutionary. No, it's overhyped. Howard Marks says that's already missing the point. Bubbles aren't caused by technology. They're caused by human psychology. Bubbles result from the application of excessive optimism, or what former Fed Chairman Alan Greenspan famously called irrational exuberance, on new developments. Think of a bubble as having two main characters. First, companies. They expand aggressively, build capacity, and spend, let's be honest, enormous amounts of money. Second, investors. They see early success, assume it continues forever, and bid prices higher and higher. Sometimes these two characters start feeding each other. Companies build and expand. Investors fund and bid prices up. They push each other, like two gears that speed up the more they drive one another. It's a giant feedback loop. Let's look at the anatomy of a bubble. It's a simple four-step pattern that repeats more often than a bad sitcom. Step 1, the new shiny. A technology shows promise. Early adopters get really excited and a little loud. Step 2, early gains. A few winners pop up. Returns go parabolic. Suddenly, the media and the insiders start shouting from the rooftops. Step 3, FOMO piles in. Now everyone and their grandmother wants a piece. Prices fly away from actual profit prospects. Reality starts to get stretched. Boom. Step 4, the painful end. The music stops. Prices fall. Leverage breaks. And investors get a very expensive lesson in gravity. Howard Marks's point is simple. The technology changes, but the plot of the play is exactly the same. Only the actors and the costumes change. And what's amazing is that this has happened over and over again. Different centuries, different technologies, same slightly predictable human psychology. So before we ask whether AI is amazing, the better question is, what kind of bubble could this be? Howard Marks makes a really important distinction here. He says not all bubbles are the same. Some bubbles are what he calls mean reversion bubbles. That sounds technical, but the idea is actually very simple. Mean reversion bubbles are financial fads. They stir the imagination with one irresistible promise: high returns with little or no risk. And whenever you hear that combination, history tells us to be very, very careful. These bubbles don't build real infrastructure. They don't improve productivity. They don't move humanity forward. In many cases, they start to resemble Ponzi schemes. Early participants get paid with money from later participants, until eventually the flow stops. Think about tulip mania in the 1600s. Beautiful flowers, wild prices, and exactly zero long-term economic impact. Or the South Sea Company, grand stories, massive speculation, and very little real business. Or more recently, the 2008 subprime mortgage bubble, complex financial products, heavy leverage, and nothing useful left behind once it collapsed. Prices rise, prices crash, and in the end, nothing meaningful remains. But then there's a very different kind of bubble. Howard Marks calls these inflection bubbles. A revolutionary technology appears that captures the public's imagination and inspires overwhelming excitement. These bubbles accelerate technological progress and create the foundation for a more prosperous future, even as they destroy individual investor wealth. Think of a non-reusable rocket launch. The booster burns a ridiculous amount of fuel. It's loud, it's violent, and it is incredibly expensive. Eventually, it falls back to Earth and kaboom, it explodes. But it does its job. It puts the satellite into orbit, and that satellite stays there. Inflection bubbles work the same way. Investors often lose money, sometimes a lot of money, but the technology survives and permanently changes the world. The speculative mania is necessary to fund the installation phase of a new technology, building out essential infrastructure that we'll all use for decades. So this leads to an uncomfortable question. If bubbles are so destructive, why do they keep happening? Howard Marks asks this directly. What's actually good about bubbles? Here's his answer. Without bubbles, investors usually have no desire to throw money at highly uncertain new technologies. Think about it. Why would a rational investor fund something that might take 20 years to pay off and might fail completely? Under normal conditions, they wouldn't. Bubbles change that. During a bubble, optimism overwhelms caution. Capital floods into areas that would normally be starved of funding. It's like planting a forest. To grow one giant oak tree, nature spreads 10,000 seeds. Most of them fail, most of them are wasted, but without that waste, the forest never exists.
The waste is essential. Bubbles do the same. They overfund experiments. Many fail. A few create the backbone of the future.
Howard Marks points out that many of the things we rely on today were built by money-losing investments. Railroads in the 19th century were massively overbuilt. Investors were ruined, but entire economies were transformed. The same thing happened during the dot-com era. Fiber optic cables were laid far ahead of demand. Investors lost fortunes, but today's internet runs on that excess. Think of it like an overbuilt buffet. Someone prepares food for 1,000 people and only 100 show up. The host loses money, but those 100 guests eat incredibly well for years. That's what bubbles sometimes do. They fund the future before the future is ready to pay for itself.
All right, framework set. We know what a bubble looks like. We know they can be good for the world. Now let's put AI under the microscope. We start with the cases for caution, the red flag suggesting today's market has a classic bubble syndrome. First up, lottery thinking. This is where the dream of a massive jackpot makes people ignore a 99% chance of failure. Venture capital and retail investors are treating AI like a giant raffle. They put a small amount into a huge number of tickets, just hoping one hits the jackpot. Take the startup Etched. They raised $120 million. The logic is that an investor only needs to believe in a 0.1% chance of them becoming a trillion-dollar company to justify the bet. 0.1%? That's basically hoping for a miracle. Then you've got companies like SSI or Thinking Machines. They're raising billions with no public product. Billions for a coming soon sign? That works for giant VC funds that buy 1,000 tickets. But for individual investors, that's a very dangerous way to play the market. The second is the efficiency trap and capital expenditure question. But here's where things get tricky. AI is not cheap. Companies are spending trillions on chips, data centers, and electricity, betting that future profits will justify today's costs. But there's a massive mismatch here. We're buying technology that might be obsolete in 3 years with financing that lasts 30. It's like taking out a 30-year mortgage to buy a sourdough starter. By the time you've paid off the loan, the technology is ancient history. And even if AI works perfectly, there's another trap. The efficiency trap. Imagine 2 kids running identical lemonade stands. They both buy expensive high-tech robots to squeeze lemons faster. They're more efficient. They're high-tech. But instead of getting rich, they realize their neighbor did the same thing. So they start slashing prices to 5 cents to beat each other. The customers are happy. They're getting 5-cent lemonade squeezed by a robot. But the kids? They're exhausted, they're broke, and they still have to pay for the robots. AI may cut costs dramatically, but competition could pass almost all of those gains to the users, leaving the investors holding an empty cup.
Another worry is the circular deals and financing gymnastics. When growth becomes harder to find, creativity enters the chat. This is when companies and financiers start doing gymnastics, round-tripping, vendor finance, SPVs. Let's look at something called round-tripping. Imagine two friends who only have $10 between them. Person A buys a pencil from B for $10. Then person B buys it back for $10. They do this all day long and then tell everyone they just did $1,000 in business. It looks impressive on paper, but no new money ever actually entered the room. Then there's vendor financing. That's when a company lends money to its own customers, just so the customers can buy the company's product. Sales go up, but risk quietly follows right behind them. Finally, we have SPVs, which you could think of as the hidden basement of a balance sheet where debt goes to hide. Now, none of this automatically means there's fraud, but historically, it means risk is building up beneath the surface, just waiting for someone to notice. If there's one thing Howard Marks really worries about, it's debt. See, debt magnifies everything. When things are good, they look amazing. When things are bad, they become catastrophic. And here is the punchline. Financing short-lived technology with long-term debt is especially dangerous. It's like taking a 30-year loan to buy a 3-year robot. When the tech slows down, that debt doesn't just disappear. It sticks around like an unwelcome guest.
This is how crashes happen. Stability creates confidence, confidence creates leverage, and leverage creates fragility. Marx compares AI today to the radio and aviation booms of the 1920s. Those were world-changing technologies, but they were terrible investments if you bought them at the absolute peak using borrowed money. It's a Minsky moment, that split second where the runner realizes they've already gone over the cliff edge.
Now, for the million-dollar question, is this time actually different? Marx asks us to consider if AI really breaks the historical pattern, and to be fair, there are some real differences this time around. First, real products. Unlike the dot-com era where companies had no revenue, AI has ChatGPT. It already has 1 billion users and exploding revenue. Second, the big tech incumbents. The leaders aren't unknown startups in a garage. They're the giants, Microsoft, Google, and Amazon. They have the deepest pockets on the planet. And third, the valuations. Goldman Sachs data shows today's leaders are way cheaper than the tech kings of 1999. Microsoft is practically half off compared to its PE ratio back then. These differences matter. It tells us today isn't a perfect mirror of the year 2000. But different doesn't mean safe. Massive uncertainty remains. High valuations and lottery thinking still create a very long way to fall if things get messy.
So, is AI a bubble? Howard Marks's answer is refreshingly honest. We don't know. AI is real. It has a billion users. It generates real revenue. This isn't just the 1990s all over again. But we also see the hype, the leverage, and a whole lot of lottery ticket thinking. His advice is simple and incredibly hard to follow. Don't go all in and risk ruin, but don't stay all out and miss history either. Stay selective, stay humble, because investing isn't about perfectly predicting the future, it's about surviving it.
At the very end of his memo, Howard Marks adds a little postscript. He steps away from the charts to ask, what does this actually do to society? If AI really works, what happens next? If productivity skyrockets, who actually gets the prize? Do we all get higher living standards or just higher corporate profits? And if machines do the heavy lifting, what happens to human jobs? Can an economy stay healthy if large parts of society are no longer needed for production? Progress is great, but it doesn't automatically mean shared prosperity. We have to ask the deeper questions. What happens to our dignity if work disappears? How do we handle inequality if all the wealth concentrates in the hands of those who own the algorithms? Technology changes what's possible, but society, that's us, decides what's acceptable. If you enjoyed this dive into the bubble, please like, share, and subscribe. And tell me, where do you think we are in the cycle? I'll see you in the comments. See you again next time.